Welcome to the Australia Post Business Talks podcast, where you can gain an insight into tips, tricks, and trends that will help improve your e-commerce business. My name is Gary Starr, Executive General Manager, Parcel Post and E-commerce Services at Australia Post. Today, it is a great pleasure to be speaking with David Mann, Chief Economist, Asia Pacific and Middle East Africa at Mastercard. And I'm really keen to hear what David has to say about the current business environment we are currently operating in and his forecasts for 2025.
Thanks so much for having me, Gary. It's a great pleasure to be here today. And maybe the first few minutes, if I may, I'll just sort of outline, as you say, a few of our thoughts of what's going on, and then happy to go into the conversation. The first point I would point out is that the Economics Institute that I'm in at Mastercard is a group within the services division that looks to try and create the better, smarter outcomes for our clients, leveraging the data that we have, but also the external sort of data that we're able to get on the usual stories that economists would all be looking for. And the big story that we think is going on today is that globally, as well as in Australia, we are finishing off at last what has been an extremely drawn out bungee jump for the global economy. If I show you all the way back to the year 1900, you can see GDP growth globally in red, with the shaded in areas in gray representing recessions: World War II, the Great Depression, the 1980s recession, the dot-com boom and bust, the global financial crisis through 2008, and then, of course, the COVID pandemic, where we had this biggest collapse in global GDP growth in 75 years. Now, that sort of extreme move down to then go from closed and then we went right back again to being reopened was so extreme that the ripple effects have still been impacting us all the way through to today. So the long story short, we would stress on what's going on today is that we have already gone through an extreme period of stress. We are at the peak period, I would argue, also of stress for households in Australia, given the high levels of interest rates that the majority of those with a mortgage are feeling today because of that lagged effect from the fixed rates mortgages that so many people had had before. But these extreme moves where we used to have such low inflation, and then we had a burst of higher inflation. We used to have extremely low migration. We've had a burst of inward migration. And it's been the same story in the labor market, with the same story with interest rates swinging from ultra low to so high. These dramatic shifts are now finally coming towards something that is settling down a little bit. And I think that's the good news that we can really be zooming in on, which is that while it's been very disorientating, just like with a bungee jump, once you've had that bounce, you lose orientation of where the ground is and the sky is. What should your expectations be over the next few years should not be influenced too much, in our view, by what's been happening over the last few years, mainly because it was just not normal. Now, the more normal period, we think, is what we're going into in 2025 and beyond. And in that regard, when we think about the rebalancing, the first thing that I would stress is that we had already seen GDP growth, as I show you on the far left-hand side with that big jump lower, the bungee jump swinging back higher again. We've been settling down more towards trend growth. For consumption expenditure, which is the PCE chart, the second one in here, similar story of the collapse, aggressive rebound, and then swinging around quite dramatically. Of course, fiscal policy and other things can play a role in here, as has the role of excess savings that accumulated during the pandemic. And of course, with inflation, we had a similar kind of pattern where we had the collapse and then a huge boom in inflation. It's been settling down, but unlike PCE or GDP, you can see we've not yet really gone back to where we think the long run numbers should be. It's been that little bit more sticky. And that, in our view, of course, helps to explain while in the case of the United States, we are seeing and likely to get some interest rate cuts coming, and it will be a continuous cycle. We think by September of this year, it'll be a later period, likely in the early parts of 2025, before we see the same thing coming from the RBA. And of all the key reasons behind it has been the ultra tight labor market. Wage growth accelerated up beyond 4%, even through the middle of last year. And we already are seeing it easing off a little bit, but I would stress, and happy to talk maybe more about it in the conversation, that the labor market is going from extremely tight levels to just less tight. And that will be the key driver, really, we think, for the RBA, is how much calmer the wage growth story can become to give them that room to be starting to cut interest rates. But of course, it does help that we think the US will already get going. In Europe, it's already underway. And that lowering of interest rates should be the very good news that we think will be coming in 2025 by later in the year, as the pressure on consumers that has gone through these surges in the cost of living in the last few years, and really also the cost of financing a mortgage, will start to see at least some relief. So some dip down towards where we had been previously on inflation, we think is on the way. So calmer inflation and calmer wage growth, which will give enough room for those interest rate cuts to actually come along. Now, when we think about what all of that means for the actual growth trend for next year, when we've looked into the forecast, say, for real GDP growth or just for, say, consumption expenditure, we think the peak of the pain is actually what we've been going through and are going through today. The low point we have for overall expenditure in Australia's economy is actually in the fourth quarter, we think, and then we'll be getting that much better through the rest of this year and into next year. So we're re-accelerating. And I think that's the positive side. And of course, the key driver also will be that lowering of inflation back towards the RBA's main objective. So those are the key things that I just wanted to stress at the opening. That it should be, we would say, for how we're going to be doing in this peak season, that we think, see something similar to last year, though the key difference will most likely be that in the November sales periods, that bargain hunting that consumers have because of the rise in the cost of living may be even more aggressively seen, and therefore even more so in the online space than the offline space. But as I stressed, we're not looking for a recession. If there is any risk of slightly softer growth, that is the direction where I would say the risk is, rather than even stronger than expected figures. And of course, that resilience of the consumer has at least partially also been supported by the tight labor market and the large rises that we had been seeing in net inward migration. So maybe I'll pause at this point and happy to go into a discussion. Thank you.
Thanks, David. Some great insights there and a great sort of macro view of what's happening both globally, but here in Australia. And there are a few paradoxes there. I mean, you talked the oscillating consumption, and obviously all interrelated, but with unemployment and then CPI and inflation. So if interest rates won't ease until you're talking the calendar quarter one of next year, so the sort of after Christmas, after the peak period. Is there any more you can share? So, and our forecasting suggests a similar sort of peak period to last year. But anything else you can talk to around the peak period, just in terms of, because consumer sentiment plays a big role here, and without interest rate cuts, will consumers still spend through that October to sort of Christmas period?
Yeah, I think that's exactly the way that we're thinking about this also, in that what we believe is going to be the story is that we're going to have some sort of similar period to last year, but the jump that we should be seeing, particularly during the sales periods, let's say around the sort of Black Friday, Cyber Monday, because we think consumers are even more focused on those good deals. It is something we did see in the years gone by, increasingly one year to the next. And we think that will still be the story, that you get that really big surge, you get that extreme amounts of even bottlenecking of just how much consumers want to spend when they see the good deals. And we think that should be the story for this year. The other thing that we think, it might be slightly early to see it just now, but we think will probably be more of a story in next year, will actually be when we get to the stage where we see some more of the desire for some replacement of some of the, I would say, physical goods. Because what we noticed in the last few years, if we go back to, say, 21 and 2022, when the household goods demand was so strong, in the last year or so in particular, we have actually seen the share of wallet being spent in particular on, say, the retail therapy rather than the experiences, say the dining or the travel. We've seen a lot more of the spending going on that rather than retail therapy. We think that will start to rebalance a bit more towards the sort of ratios that you would have seen in the pre-pandemic period, partly just because of a replacement cycle. And also there is an ongoing, still, I would say, underperformance of prices when it comes to electronic goods. We still have that story, and in particular with the story from China being of exporting lower inflation around the world, that should also be adding to that story to at least some degree. So it could be even in this season, there's a slightly better demand on the electronics side than there had been in years gone by. But we think that probably is even more of a story for 2025 as the replacement cycle gets a little bit more underway. The other thing that should be helping through next year, more likely also, will be that with those rate cuts, that could also give a little bit more life to the housing market, provide a little bit more of the activity there, which could mean even more of the demand for the usual sorts of household goods that come alongside when people are moving around. And so more activity in that area alongside electronics, we think, is what we're likely to see next year. Also, in terms of growth rates, there is a limit to just how far we can go on the travel recovery that already has been so strong in the last few years since the reopening. We're getting towards the point of saturation there. And of course, the price rises had been quite strong. The key thing we think for consumers, and we'll be watching it in this season, will also be to what extent are we going to see the more affluent consumers still outperforming, while the lower income consumers that have been feeling even more of the pressure from the cost of living, from essentials expenditure and the share of spending, say, on groceries and fuel being that much higher, will we see some of that start to also correct where we see a bit more of a broader strength? And we think, again, that's probably more of a 2025 story with the rate cuts coming as well. The key thing also that I should stress is that we've been quite lucky so far on the inflation front from the fact that commodity prices have been pretty well behaved, in that we've not seen any aggressive spike in, say, crude oil prices. The ultimate cliche for any economist is to talk about oil prices and the impact that you would get if you had a major spike. And we've not yet had that, even with all of this litany of concerns that you could be raising on the geopolitical front. Doesn't mean it can never happen, but it is a factor to watch for. But so far, fortunately, that has not been the case.
Right, and just to take that a bit further, I mean, you talked about some areas of consumption, but are you we saw massive growth in home and garden through COVID, obviously, because people were at home. And you talk about electronics, and then building obviously stimulates a purchase for the home. But so you do expect that to, are you saying you expect that to bounce back as we see quite a lot of initiative around building, but also people start to be more confident and interest rates come down, that category will start to grow?
Yeah, I think it could be a bit premature to call for it to be strong immediately. We think it probably is more like a 2025 story where that should be doing that much better, we think, for all the reasons that you suggested. The other key thing that we'll be watching for, of course, will be on the overall labor market, but also the state of migration. Because the key thing that has really been helping out a lot of retailers and keeping a lot of the activity much stronger than it would have been otherwise has actually been the rise in the population overall because of the migration trend, where we saw a surge in migration through 2023 and in 2024 as well, before starting to ease off. Now, that has really helped us to avoid an overall recession in GDP, as well as on consumer spending. So at the aggregate level, we still have something that's positive, but on a per person basis, it's actually been negative for a while. So there's already been this, I think, reflection of the pain taken by the rise in the cost of living in per person consumer spending. The key question for us is, now that we have less on the migration trend, that you won't be seeing that growth as strong as it has been over the last year or two in 2025, but we will see some relief coming from the RBA. That's why we're a bit balanced on exactly where the growth will be. We think slightly better, but very marginally. I would say, as you're saying with your forecast, we would agree that it's a similar story to what we saw last year, rather than it being a recession. And I think that's the key thing, that I think too many times in the last few years, because of how disorientating everything has been with ultra high interest rates, high inflation, a lot of folks have been panicking, I think, prematurely over an actual recession, particularly somewhere like the US, where 2023 was meant to have been a recession, and it turned out to be an above trend growth year. And I think this resilience partly comes from the labor market, but also comes from migration and from the excess savings that had accumulated during the pandemic. In Australia's case now, savings rates has actually gone below where it is normally. And therefore, we're starting to see some using up of some of these excess savings, folks digging into some of that. And that buffer that's there is the extra, I would think, benefit that really is helping us to avoid what otherwise would have been a more painful period already.
So that's really interesting, and I guess it's a for all those online to think through just what that means in terms of the next 6 to 12 months. If I could turn now to international markets, in 2022 to 23, we saw a doubling of merchants selling overseas. That's somewhat tightened this year, but there's obviously many of the people listening today do already sell overseas or be contemplating that. And you've spoken about interest rates being low, exchange rate being lower, I should say. But how do you see international markets and the opportunities for Australian businesses selling to the rest of the world?
Yeah, I think that's a really fascinating question because when we think about where global growth actually comes from, I just started sharing my screen again, but I'll talk to it for those who may or may not be able to see it. Actually, Australia being in this part of the world in the Asia Pacific region is one where it's closest to the fastest growing markets, where the rising middle class story emerging from being an emerging market to middle income and then even eventually higher income. Most places around the world that are seeing that are either in Eastern Europe or in Asia Pacific. And I think the Asia Pacific story, even including China, where we think next year will be growing around 4%, maybe 4.5%, which is half what it used to be 15 to 20 years ago, will still be adding a serious amount of contribution to overall growth. But it's not just the China story that even though it's weaker than it used to be, it still is a major factor. The other key markets that I think are at least worth looking into and considering are, of course, India, where if we can see 7% real GDP growth, which is actually our forecast for next year, if that can become the trend, then India's economy can double every 10 years when it compounds at that sort of rate. And we are already likely to see an extra 5 million high-income consumers in India in the next 5 years and 20 million middle-income consumers being added to that economy. So it has that sort of population scale. It's now a more populous nation even than China, and it has that growth rate. So the momentum, as you can see from the contributions that we look at to global GDP growth coming from India, from China, but also coming from the ASEAN region itself, Indonesia, Thailand, Philippines, Malaysia, Singapore. These are economies we think that also still have a very strong contribution to where global growth and therefore demand, if you're looking outside of Australia, where will the growth delta be coming from? Many of the places are down in South or Southeast Asia. And I think that is another interesting thing, separate to the usual suspects of, say, Eastern Europe or the UK or the US, much further afield, I would say, much more of a logistical challenge compared to some of the more, I would say, closer by, quote unquote, locations. So I think that's the good news in that it's a good economic neighborhood to be in. So for those focused internationally, I think South and Southeast Asia looks like a good one to focus on if it makes sense for your business.
And that's really interesting, David, because as you know, our major export markets are New Zealand, the UK, and the US. So opportunity in those as those markets grow, the middle class grows and GDP growth, some of those consistent GDP growth do represent opportunities in those markets that are sort of consumption markets. That's really interesting.
Yeah, path less trodden, I would say. Yeah, that's right. I think
path less trodden. And what
exciting part for the future.
That's exactly right. So it's good food for thought for those listening today. And what does the exchange rate have an impact? Because a lot of exporters have enjoyed the benefit of a slightly weaker Australian dollar. It's been sustained for a period, but I assume that will strengthen in the next little while, as per what you discussed earlier.
Yes, I think that makes a lot of sense. That if we're finally now getting to the state where we're going to be seeing US interest rate cuts, and it's starting a lot earlier than we'll see in Australia, and we think it will continue all the way through 2025, that should also mark finally the end of dollar strength. It's not immediate. We don't think it's from today onwards necessarily, but I think we've already clearly seen a lot of those signs, especially since the ultra aggressive turnaround from being so weak to being a bit less weak in the Japanese yen. It's about 10% stronger than it was even when we took some of the observations just a few weeks ago on where the exchange rates had been moving. So in Australia's case, actually, if we go back since the beginning of 2022, we can actually see that certainly the Aussie dollar against the yen is still about 20% stronger. There's a few markets out there, Korean won and India, even including the Kiwi dollar, where the Aussie dollar is doing better. But those ones that it had been a bit behind on, we think there could be a little bit of a turnaround coming in that regard. In particular, against the US dollar, it's still about 8% down compared to where it had been in 2022. So we think next year we could be breaking that bit higher into the 70s for the Aussie dollar. Of course, that means when it comes to selling internationally, the competitive side may not be so good, but the purchasing power for Australian consumers and businesses to be buying from abroad should also be helped. And that slightly stronger Aussie dollar as well should also be an added reason why the RBA could be a bit more comfortable on the rate cutting cycle too.
Great. So look, thank you, David. That's really interesting. And as I said, great food for thought for those who are already selling overseas, but those who are considering doing it. And look, we are just out of time, unfortunately. I have so many more questions, but we're out of time. So thank you so much for joining us today. I think your perspectives have given us a valuable insight and a lot to consider.
Thanks very much for having me.
Thanks, David.